So the question is question number 22 of December 2022, and it says that Mrs. Jane Wakwa is a marketing director of Uma Limited, a company that makes and sells electronic devices. The company is considering the launch of a new mobile phone model branded Trex. The available data is only fully reliable, though Jane still feels that she can make a recommendation on whether or not to launch Trex. Additional information is that Trex is estimated to have a shelf life of 5 years commencing year 2023. Trex will require the purchase of a machine at a cost of 100 million at the end of year 2022, after which the machine will be sold for shillings 20 million at the end of the 5th year. The selling price and cost structures of Trex for the first year 2023 with expected inflation factors are as follows. So we have the inflation, selling price, material costs, direct labor costs, incremental fixed cost, which excludes depreciation. The company is eligible for capital allowances, that is depreciation for tax allowances, tax purposes, at the rate of 25% on reducing balance. At the end of the project, when the machine is sold, any gain or loss on disposal will be considered for tax. The tax rate on income and capital allowances is at the rate of 30% per annum. Assume that the tax for a given period is paid in the same year. The project will require an initial investment in working capital of shillings 20 million, which will be increasing by 5 million at the end of each year to cater for general inflation. The whole amount, whether with a periodic increase, will however revert at the end of the project. Experience has shown that demand for new products is not exactly known in year one, but tends to be stable thereafter. Jane has come up with the following estimates of demand for the year 2023. We have the probabilities and the expected sales. Jane expects an initial increase in demand in year 2024 of 25%, then a decline of 50% in year 2025. This level will remain the same till the end of the project. Uma Limited has a real weighted average cost of capital, WACC, of 8%, and general inflation is expected to be 4%. Due to the risk of the project, Jane feels that the relevant nominal weighted average cost of capital should be increased by 3%. Required, compute the following. A, the weighted average cost of capital to be used to evaluate the project, the relevant cash flows over the project period, the net present value, NPV, of the project, and you advise on the viability of the project. Then you prepare a loan amortization schedule for a principal amount of Kenya shillings 1 million with an annual interest rate of 15% for 4 years. Good. So with that, we embark on submitting the solution. So we'll have our solution there. And the first thing that they want is, we can copy this one here, come and paste it here. Yeah, so when we do that, we can actually make it bold. The one that will be used, the WACC should be equal to, we normally say it is equal to real WACC. Get some good space. So it is the real WACC plus general inflation plus general inflation plus general inflation rate plus additional risk. Additional risk rate. Additional risk rate. So the real inflation, we have it according to this. Sorry, the real. Sorry, it's still I get another one here. So with this now, we have real WACC. Then we have general inflation rate. Then we have the risk, the risk adjustment, the added risk factor. The added risk factor. The added risk factor. So for the real, what we can see here, the real weighted average is 8%. So it's 0.08. The general inflation is 4%, as we can see up there. The added risk, the nominal, 0.03. So now my WACC. So WACC to be used should be here, which is going to be the sum of those three. So you can convert them into percentages. You can convert them into percentages. This one, you can come here and put it within borders, top and bottom border. Yeah. So did we agree on that?
Yes.
Good. So if we have agreed on that, the next thing is they're asking us to get the relevant cash flows. So we come and bring it here. The relevant cash flows. So the cash flows over the project period, obviously we will have a column that will have, I can have my details here. I can have my details here. Then this project is beginning in the year 2023 to run for 5 years. So it will end at 2027. So I can come and I want to estimate so that I am left with some columns here. So 2027 is 2026. This is 2025, 2024, 2023, and 2022. Yeah, I wanted at least 2 columns in case I require to work out some things without necessarily taking them to workings. Okay. So when you're told to, when you're told to work with the figures, let me see how they are, how big they are. I see whether I can, I think I will work with them being the way they are. So for the purchase of, no, let me remove these ones. Let me remove this one. Yeah, the figures will be bigger than my space. So the cash flows to the project, obviously, there will be purchase of machine, purchase of the machine, that would be the first one. Then there will be the residual value or the sale of machine, sale of the machine. That is the residual value. Then from there, we will have revenue because we are selling. That's another cash flow, revenue. Then we will have the outflows, some other outflows. We will have material costs. We will have labor costs. We will have fixed costs. We will have tax paid on profits. Tax paid on profit, that will also be an outflow. We will also have tax saved because you have been told there will be capital allowances, so tax saved on sale of machine. There will be the recouping of the working capital, which you can also choose to put up there, whichever way. And then from there, we will have the net cash flow. So they are just asking us for the net cash flow. Okay. So with that, I think I don't want to combine it with the NPV to we work it out on its own. So we can come here and have workings where there will be need. Now, the first thing, let's look at the purchase of the machine. The purchase of the machine, we are told that this machine will be, the purchase of the machine will cost 100 million at the end of the year, 2022. So it will be sold for 20 million at the end of the 5th year. So let's come to, maybe we could add another line here. We could add another line just for clarity. This is what we call year 0. This is what we call year 1, year 2, year 3, year 4, and year 5. Just for clarity, not very important, because you can still count. So this machine will be bought at the beginning of the period, that is 2022, and we are going to spend 100 million. 3, 1, 2, 3. We are going to spend 100 million. So let me format my space here. These cells. I want to format the cells. Currency. I don't want to use decimals. I don't know whether there will be decimals, or I can use 2 decimals. There will be no harm. Or instead of putting the currency, let me put it as numbers. As numbers, instead of putting the Kenya shillings to avoid taking more space. So separator is there, 2 decimals. Good. So this one I extend kidogo. Yeah. So that is the amount. That's the amount. Then we are told that the machine will be sold for 20 million. So when we sell the machine, it will be an inflow. So 20 million. 20. 1, 2, 3. 1, 2, 3. So that is what will happen. Sale of the machine, end of the 5 years. The next thing that we need to look at, inasema nini? Inasema the selling price and the cost structures are like, with the expected inflation. So we have the selling price here. Okay. They are going to change here because of these inflations. So from year 2024. So we have to come do an adjustment here. Working 1, call it working 1. Adjustments for inflation. Adjustments for inflation. We can just copy these items the way they are, these ones. Just copy. We come and paste them here. Then these are the values that will be there. These are the values that will be there from the year 2023. So 2023 is our F here. So we put them there. Then these inflation rates, this one we can use them the way they are there. We don't have to bring them here. So we are told that there will be inflation. Now inflation makes these values to increase, and it's going to be increasing every year from year 2024 onwards. So when I come to the selling price here for 2024, I will say it is equal to what I had here times, open the brackets, 1 plus the inflation rate. The inflation rate, this one. And because that one will remain constant as we go forward, you need to lock it. You press F4. Then you close the brackets, press enter, and then this one we are supposed to go up to, column J. That's where we have our last figure. So, sorry. We are taking them this way. So those are the selling prices. The selling prices. I think I will have to remove the decimals. Let me format these ones. I remove the decimals, format cells. I want them to be numbers without decimals. Use 1000 separator. Okay. What is happening there? Oh. I want to format. It's that way. That's what I want. Then let's come to the price, the material costs. It is equal to this one times, open the brackets. I go take my inflation rate for, sorry. I needed to have said, but it's still okay. I can still lock it. That way, then I say +1. Then I close the brackets. Either way can do. So then this one, we autofill up to this point. We come now to the direct labor cost. We see it is this value times, open the brackets, 1 plus, we go get this inflation rate, this one, and then we lock it. We lock it, close the brackets, press enter. Then you drag all the way up to here. Let's go for the increment of fixed costs. That one times, open the brackets. You say 1 plus the inflation rate. The inflation rate is 10%. We lock it. Then close the brackets, press enter. Then you come here and good. So with that, are we together at that point? Are we together at that point?
Yes.
Good. Now, the next thing that we need, is to get the sales units. So this one, I can come here and talk of expected sales units. The expected sales units. So how do we get the expected sales units? First of all, let's see whether they will change. So the sales units, we are told that Jane expects an initial increase in demand in 2024. So these ones are for 2023. how we get the 2023 here, this is 2023. It is going to be equal to the probabilities multiplied by the units. So it's going to be equal to this times this plus this times this plus this times this. That is how you get the expected value. The expected value. Okay. Wanted to format this. Let me format zote. So from there now we are told Jane expects the initial increase in demand in year 2024 of 25%, then a decline in 50% in year 2025. This level will remain till the end. So in 2024, we are going to have an increase of 25%. So this will be equal to this times, open the brackets, 1 plus 0.25, close the brackets. Those will be the number of units. Alafu sasa tunaambiwa kutoka hapo a decline of 50% in 2025. So here it will be equal to this multiplied by, open the brackets, 1 minus 0.5, close the brackets. So those will be the units there. Then we are told that this level will remain the same till the end of the project. So if it remains the same, kumaanisha this one I just come and bring this one. I can either copy or just bring it that way. Either way, it will remain constant. It will remain constant. So if we are together at that point, how do I get my revenue? I know so well that revenue is equal to selling price times the units. Selling price, this one, times the number of units, this one. Selling price times the number of units. So, that way, spad kidogo. Ani ifika ni kubwa aje. Okay, then I drag up to that point. Then I drag up to that point. Let me reduce my font so that I'm able to see all of them. Yeah. Higher. Let me go now to my material cost. Material cost is supposed to be given as the material cost per unit, this one, times the number of units here. Then I drag all the way up to here. I hope I've done the right thing. I drag all the way up to that point. Higher labor cost the same way. It is equal to the labor cost, this one, times the number of units. That way, up to that point. Fixed cost, the same style. I take this per unit times the number of units. Then I drag all the way up to that point. Now I have to get the tax paid on profit. So maybe I needed to come here and say that anyone who is looking for my answers in revenue, they should go to working one. The same case here, working one. The same case, working one. The same case, working one. Now I need to get the tax paid on profit. So I need to compute the profit somewhere. I need to compute the profit. So for me to compute the profit, I need a working here. And the only thing that is missing, now on these figures, remember profit is equals to revenue minus cost. The only cost I'm missing here is the depreciation. And depreciation, because it's not a cash flow, that's why we have not brought it here. So I'll need to first of all get depreciation, then use it the normal way to get the profit. Then from there, I determine the tax to be paid. And still on the same note, it will help me to know whether there is any tax saving or tax loss on the sale of machine. So let's come here and do working two. Computation of depreciation.